you potentially are losing millions of dollars and you're probably not even aware of it. See, many of us invest our retirement money with our employers' retirement accounts. Now, many times these employers hire on firms to create these accounts, things like 401k, simple IRA, and there's no expense to the employer. But somebody needs to be paying for those Wall Street people to set all of it up. Well, it turns out that somebody is you. And there's this hidden fee in the world of retirement. It's called an expense ratio. And oftentimes these funds will charge you a 1% fee on your money every single year. Now that doesn't sound that expensive. And that's why it's so insidious, is that it turns out that that is incredibly expensive. Let's take an example. Let's imagine that you were investing $1,000 every single month for your entire career of, let's say, 40 years. And let's say the market's returning an 8% rate of return on your money. Over time, if you had the 1% expense ratio fund, you will have earned $2.5 million. That sounds like a great account, and it is, until you realize that if you had a lower expense ratio of fund, then you would be getting about $3.4 million, almost $1 million difference. And this is actually 34% more money in retirement. Think about what you could do with an extra cool $1 million in your pocket at retirement. It's a massive difference, even though it sounds so small. So how do you fix this? One simple method is simply ask what the expense ratio is and all the different funds in your retirement account. And you can then work to find the lower expense ratio funds. That's good enough. That will get you a good chunk of the way there. But if you want to go deeper with me, we can start to talk about and share with you exactly how these funds work so that you can save even more money. It's going to be a little bit technical, but if you bear with me, it's some of my very favorite stuff in the world of finance. See, a lot of times you'll be asked or recommended to invest in a fund, a target date fund. So if you're planning to retire in the next 20 or 30 years, your target date fund might be the 2050 fund. But again, because there's management of them, they tend to have higher expense ratios. But if you understand what's going on underneath the hood, you can replicate that fund in a more inexpensive way. So these funds, they're thinking about really two major things. The first is diversification. See, many of us, when we first think about investing, we think about those cool stocks that we could get into, things like Tesla or Apple. And we want to put our money in there and hope they do well. Well, let's think about that for a moment. Let's actually chart it out. So I'm going to draw a chart here. On the vertical axis, I'm going to put the percent return. This is the amount that you could earn in any given year. Maybe it's 1%, maybe it's 10%, maybe it's 100%, maybe you lose 50%. And then the other side, we're going to put just years. So if you were to invest in Apple, what you'll find is that there's some volatility. Some years it does well, some years it does poorly, goes up and down. But on average, you're going to do okay with that stock. Now, let's think about this maybe a little bit deeper. Is there something that we can do to actually reduce the volatility, reduce that risk that we take on, and maintain or increase your rate of return? Well, it turns out there is some magic. And that's simply adding a second stock. Let's take a look at it. Let's say we were going to add on Tesla. All right, let's jot that one on here. Maybe that one goes like this. Like that. All right, we have two stocks on there, but what is our average return between the two of them if we did half of each? Well, let's look at it. When this stock did well, this one's doing less well, we split the difference here, right down the middle. In fact, we can start drawing a line that is right in the middle, because that's what the return you would get. Now here is the tricky thing. Notice which line has less volatility. Was it Apple? No, they're pretty volatile. Was it Tesla? No, they're pretty volatile as well. But it turns out when you put them together, the red line here is less volatile than both of them while still giving you a good rate of return. This is simply because sometimes when Apple is up, Tesla is down. And sometimes when Tesla is down, Apple is up. And so this notion of diversification, this is one of the key things that investment funds work to provide you, is to buy into a whole basket of stocks and investments to lower your risk while maintaining a high rate of return. Now, how do people even measure risk? Well, it's how much this line changes over time. And there's a particular measure, there's a particular statistic that we can use to measure that volatility. It's called standard deviation. I'm not going to get into all the details of standard deviation here, but just know that when you have a high standard deviation, it means there's a lot of variation in this line. A standard deviation of 0 means that you have a perfectly straight line. Okay, now let's think about the second major thing these funds are thinking about. And that is that as you get older, you can't take on as much risk as you could when you were younger. When you're younger, you have a job and you have many years of working life ahead of you. If you happen to take a hit now on one of your retirement funds, you have the time, the luxury to wait for that retirement fund to build back up. But as you're older, especially once you're in retirement, you can't afford to take those risks. If the stock market drops by 50%, that could totally, radically, and negatively impact your lifestyle. So over time, you want to reduce the risk of your fund. So let's think about how managers kind of manage this. So I'm going to draw a new graph. We're still going to have percent return, but now on the bottom, instead of having years, we're going to have risk. And how do we measure that risk? We measure it with that standard deviation. Okay. Now, if we look at all the different kinds of assets there are in a market, some will have higher returns, some will have lower returns, some will have higher risk, some will have lower risk. Maybe private equity, they have high returns, but maybe high risk, so maybe they're up here. You have corporate bonds, they're lower risk, lower return, they may be down here. But then Tesla, they might be, I don't know, there. Apple, over here. Microsoft, there. And you can start adding on all of these different possible investments in the market. How do you make a choice? Which one is the right investment here? Well, you want investments with higher risk, or with lower risk and higher return. If you're being thoughtful about this, you start to realize that those best investments, they're sort of out here on the edge. And we can actually draw a pretty cool curve. This is called the investment frontier. And these are the best investments that you could invest in. Now, if you're being really thoughtful, you realize there's one more trick that we can play. And that is that we can introduce the risk-free investment, the U.S. government bond or a savings account backed up by the U.S. government. This is going to be zero risk, but right now is actually giving a pretty decent return. Now, what you realize is that you could do a mixture of two investments, sort of this most efficient investment and the risk-free rate of return. If you average them out, because you could do small amounts of the risk-free return and high amounts of this investment or vice versa, you can actually draw a line then to represent your entire investment horizon, the most efficient investment horizon that you could get. And it's this line that people are using to think about your investments. Now, I wish we could actually figure out the most efficient investment in the marketplace. If we could do that, we'd all be billionaires. But what most people do instead is they plug in here the S&P 500, just some kind of average of the entire stock market. And then this point is your risk-free government bond or savings account. Now, what you can do is as you are younger, you can invest more of your money into the S&P 500. As you get older, put more of your money into this government bond. But those are the only two real asset classes you need to be in. Something that's broad, covers the entire market, and something that is your risk-free rate of return. And this is fundamentally what these funds are doing. They're maybe a little bit more clever in how they invest in these major assets, but generally speaking, they're investing overall in the market when you're young, investing more in risk-free bonds and things of that nature as you grow older. So, very simply, you can invest in those two asset classes, and you're going to be set in creating very much a very similar investment vehicle than you would by investing with these larger funds. And what's key here is now you can save that expense ratio even further, because these S&P 500 broad index funds are among the cheapest funds that you can put your money into. Now let's actually take a look at another graph. Over time, as you are young, so this is now years again, and over here you are young, and over here you are old. What you're going to find with an investment strategy like this is that it's going to be very volatile in the early years. But as it goes on, it becomes less and less volatile. And the other interesting thing is that your average rate of return will start off high and then slowly decrease with time. But that's okay because you want lower risk with time to protect your assets as you grow older. Now I have one last thing to share. And this is really interesting because this is how money is made with the ultra high net worth people, the people making the real dollars in the economy. We go back to our prior graph where we showed the risk along the bottom and the return on the side. If I could spell risk correctly, that would help. There we go. So now we'll put all the different assets back on the board. We'll plug in that S&P 500 here. The government bond back here. And now we'll draw our line. Now what you'll find is that there are some assets that actually give you more money than this strategy. And that difference, like this asset here, is actually higher than that line. This asset here is higher. That asset there is higher. And that difference between this line and that investment, this is called alpha. And if you can find the investments up here that give you that outsized return, that's when you make some serious money. Now, don't get me wrong, this earlier strategy is good. That's where most people should sit and where I have a lot of my retirement in. But that's not where I make most of my money. Most of my money is in these sorts of assets. Now, it's hard to get these kind of assets in the stock market, but where you can get outsized return is in alternative investments. Now, this is a bit of a scary world because there's lots of alternative investments that are not good, but there's also a lot of them that return great incomes, things like private equity. But one example of an alternative investment that's well understood and that provides an outsized rate of return is real estate. There are deals like syndicated deals where you can get really strong IRRs or high rates of return. There are funds that focus specifically on providing capital to this market. It's a very high capital needy market, and it's one that's not completely efficient. So it provides a lot of opportunity for outsized returns. We too have an investment option that gives people great rates of return into the real estate that we have in place. But no matter where you go, and we'll share some information with that in the description, but no matter where you go, you can find opportunity in this space to make a lot more money. So with that said, this gave you kind of a quick overview of ways that you can actually drive down that expense ratio, earn yourself $1 million, but even more than that, it's giving you a little bit of peek into how people make the real high income. Thanks for watching.